now, we're going to be taking a look at some of the analyses that we have looked at previously. In particular, we're going to be taking a look at the S&P 500 or the ES futures, which I last spoke about a month ago, and so an update is definitely in order. And then we're going to take a look at the euro to US dollar, and then I'm going to move on to answering some frequently asked questions. In particular, I'm going to try and answer some questions that we've had about the composite model and the composite model line, and I am also going to be speaking about choosing your analysis period, which is the first thing that you need to do when you're working with Sentient Trader. We've had a lot of questions about it, and people seem to be concerned about getting it right, which of course is important. So I'm going to be speaking about that in today's. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. They are very important and they are legally obliged. So now that you are aware of the disclaimers, let's take a look at the markets. And let's start with a look at the S&P 500. This is an analysis of the ES futures. And as always, I'm going to be starting with what I call the default analysis, which is the analysis that Sentient Trader has performed without me doing much to it, because I created Sentient Trader to speed up the analysis process, and over the years I've discovered that Sentient Trader has become a better analyst than me very often, and so I find it very useful to always have a chart in any one of my workspaces. Default analysis. I can get busy pinning troughs and affecting the analysis and changing things and exerting my opinion over Sentient Trader, but I always keep a default analysis chart available so that I can see what Sentient Trader thinks, because I've learned it's quite useful just to keep an eye on that. And let me turn on this pen. In this analysis, you can see the bigger picture details, which of course haven't changed since our last discussion of this analysis a month ago. First of all, we have a very prominent trough over here. That's in March of 2009. That is a trough of the 54-month cycle, which is the semicircle that you see along the bottom of the chart. Of course, when the semicircle moves down to a low position, that's an indication of a trough for that cycle, a low price for that particular cycle, and then when the semicircles bounce out, that indicates bounce out of a trough, that indicates that that cycle is influencing price to move up towards a peak, and when the semicircles are moving down, it tells us that that particular cycle is influencing price to move downwards, back down into a trough. The semicircles are a useful way of visualizing what the cycles are doing, and so that's why I always start with a look at those semicircles. And so we can see here we had in March of 2009 we had a 54-month cycle trough. The next 54-month cycle trough, according to this analysis, was in late 2012. And for those of you who are new to Hurst cycles, you will notice that the move down into the 54-month cycle trough was not very impressive. It was this little move down over there. And that is one of the first things that you learn about Hurst cycles, is because of the combination of multiple cycles, cycles get twisted and distorted out of shape. And so it is by no means impossible that small move down into a trough of the 54-month cycle. It's a very important thing to bear in mind. Okay, so what has happened since then? Well, if we zoom in a little into this chart, that according to this default analysis, we have had one 18-month cycle, which played out from the end of 2012 over here, and formed a trough. Again, I say according to this analysis because we'll take a look at some alternate views, and the 18-month cycle trough formed in October of 2014, October of last year. So it was a fairly long 18-month cycle. Now, something that's worth pointing out right now is that during this period from October 2012 all the way up to sort of late 2014, it was very difficult to perform a cycle analysis, because a traditional Hurst cycle analysis involves identifying the troughs in the market. And what happens when you get a very straight line upwards move like this, downwards move for that matter, is it becomes very difficult to identify the specific troughs that are forming in the market, because there is so much bullish pressure now. And of course that bullish pressure is being caused by the longer cycles. In particular, you can see the orange semicircle 54-month cycle, and potentially other even longer cycles were exerting an upwards influence. And so because of that strong bullish underlying trend, we call it, or bullish pressure from the longer cycles, it makes it very difficult to identify those troughs. And so that's something to bear in mind when we're looking at this analysis. But if we accept that the 18-month cycle trough did in fact form over here in October of 2014, then the next thing that happened was the formation of a very prominent trough recently at the end of August this year. And that, according to this analysis, is the 40-week cycle trough. Now, this is an analysis that I presented to you a month ago, so there are no big surprises. Let's zoom in and see what has been happening so that we can look at this analysis in a little bit more detail. I see a comment from Paul, or perhaps a question: since static cycles need to be rephased and there is constant left and right translation, do you ever use dynamic cycles? Paul, I know that some cycle theories differentiate between what they call static cycles and dynamic cycles. According to Hurst cycle theories, all the cycles that we look at are effectively dynamic, because they all experience variation in terms of wavelength and amplitude. And so the cycles that we look at and the cycles we speak about, although we use particular fixed names for them, such as the 40-week cycle or the 18-month cycle, they are all effectively dynamic cycles. We expect their wavelengths always to be changing. The wavelengths increase and then the wavelengths decrease, and their amplitude increases and decreases. So effectively, they are all dynamic cycles. Probably not dynamic cycles strictly according to the definition of there's a particular analyst who speaks a great deal of dynamic cycles. His name eludes me at the moment. But the cycles we look at are dynamic. Her cycle principles are by their nature dynamic. And so what we're looking at is cycles that are constantly expanding and contracting and are therefore fairly dynamic. But what tends to happen is that although a cycle might expand and contract and change its characteristics, it fits into a cycle model, which is sort of a list of cycles. So we speak about an 18-month cycle. A short example of an 18-month cycle might play out in 13 or 14 months. A long example of an 18-month cycle might extend to almost 2 years. So it's dynamic in that sense, but the important thing is that that particular cycle always fits in that position in the cyclic model that we use to analyze the markets. I hope that begins to answer that question, or helps you a little bit with that. Let's take a look at what's happened recently in this analysis, and just zoom in and take a look at some of this detail here. You can see that the 18-month cycle trough, according to this analysis, and of course I must remember we might have many newcomers with us. The troughs of the cycles are marked in a Hurst cycles analysis, are marked by means of diamonds at the foot of the chart, and the diamonds are color-coded in Sentient Trader, and the yellow diamond is the trough marker for the 18-month cycle. And you can see that the principle of synchronicity, which we have spoken about in the webinar, tells us that the troughs in this particular market are synchronized, so the troughs occur at the same time, which is why we get the particular type of price action that we get. Take a look at that webinar if you haven't seen it yet. But we get these very strong plunges into troughs and very strong bounces out of troughs, and that's because of the synchronized troughs in the cycles, between the cycles, whereas we tend to get fairly rounded peaks. We don't sort of sharp rises and drops out of a peak. That's because of the principle of synchronicity. Okay, so according to this analysis, we had a 40-week cycle trough, which was this trough here in August. So that's our default analysis, and it makes a good sense. One of the things I really like to do in an analysis in order to consider whether it's a valid one is to line up the positions of the troughs according to the analysis with the low points in the price. So there's a really obvious one. The October 2014 18-month cycle trough was really obvious. The 40-week cycle trough looks really obvious, but I'm going to speak in a moment about a possible alternate analysis which might surprise you. And the 20-week cycle trough, you can see, lines up with a fairly good trough in price. Or you could argue it could have been there, it could have been here, could possibly have been an early trough over there. The 80-day cycle trough over here in June lines up with a fairly good trough in price. But here is something that causes me to raise my eyebrows and ask a question. We have a very prominent trough in price over there, and you can see that in this particular analysis, that has been phased as only a 20-day cycle trough. Now, while that is possible and it doesn't invalidate this analysis, it does cause me to ask some questions. So I have a big question mark about that, and I'm going to come back to that a little bit later and discuss a possible alternate and discuss something that just might be happening. But let's keep going with this analysis, ask ourselves what this analysis tells us to expect. So I'm going to shift right a little bit and let me zoom in yet again and speak about what's been happening since that 40-week cycle trough. This is what we do, and you're going to get very used to this as you work with Hurst cycles, is that we start with the bigger picture and we zoom in and in, further and further and further, and consider what is, what's happening and what the analysis is telling us. Okay, so here's our 40-week cycle trough and what's going to happen next? Well, according to this analysis, we had a 40-day cycle trough over here in the last week of September, the last few days of September, and of course we expect an M-shaped cycle, and so this is what we would expect for the 80-day cycle. We're expecting a move down into the 80-day cycle trough over there. Okay, so clearly the market is bouncing up now to the second peak. Remember that cycles cause M shapes in the markets. If you haven't heard me say that before, then go and take a look at some of our videos about it. I won't bang on about it too much, but cycles tend to form M shapes in markets, and here we're seeing the M shape developing. So you can see that price is rising up to the second peak of the current 80-day cycle, after which, of course, it is expected to fall into this 80-day cycle trough over here, which is expected, looks like about the second week of November. So that's according to this analysis. But now, how much is that price going to move down into that trough? Let me just clear this drawing. And what about the fact that the price is bouncing out of this 40-week cycle trough over here? Surely if it's bouncing out of that 40-week cycle trough, then we should expect a really big bounce. And what about the fact that this 40-day cycle here was so disappointing as the first 40-day cycle coming out of a 40-week cycle trough? We would have expected it surely to be much more bullish. It should have had a much more bullish shape. Well, yes, there are several questions all bunged together there. So, and these are questions that we've received recently. So let me try and answer them. First of all, does the fact that we've had a rather miserable 40-day cycle following the 40-week cycle trough, does that invalidate that trough? And let me just show you what I mean by a miserable 40-day cycle. Here is the M shape of that 40-day cycle. You see it's not very bullish. It increased price slightly, but not by a huge amount. Does that invalidate the 40-week cycle trough? No, it doesn't. In my experience, I have often found that following the formation of a very big cycle trough, we do often get a fairly neutral shaped cycle first. I don't know why it is. I don't have an explanation, but it's something that I've observed. And so when you get a small cycle forming a fairly neutral shape like that, following what you expect to be a really big trough, it shouldn't invalidate the position of that trough. So that's the answer to that question. Now, how much do we expect the market to come down into this 80-day cycle trough over here? Well, that's a really interesting question, because if the 40-week cycle trough did form over here, then perhaps it's not going to come down very far into the 80-day cycle trough. We've had a fairly neutral 40-day cycle over here, but are we going to have another neutral cycle? Probably not. We would expect the 80-day cycle to actually, give us a bit of a lift. So perhaps the price will only come down to that sort of level over there, 1980, something like that. We have a new tool in Sentient Trader, which you are probably aware of, which is called the composite model line. And basically what happens with the composite model line is that Sentient Trader takes all of the information that it has about these cycles, and it plots a line on the chart which tells you that according to the cycle information it has, that is what price should have done when looking at the past. And moving forward, if the cycles continue to beat with the same rhythm, in other words, their wavelengths remain the same. Well, that's not strictly speaking true. They don't remain the same, but if the wavelengths continue as they are for one beat of the cycle, after which they will return to the average length, okay, then this is what will happen. So now this is the composite model line for the S&P 500 for this particular analysis. Now it shows us a very interesting situation, and so let's consider what it is saying. There's several. We've had lots of questions about the composite model line, and so I'm going to try to answer as many of them as I can in this particular discussion. First of all, and I'm going to remember, is that the composite model line is not rooted to price at this point. And I see another question there. I'll get to that in a moment. The composite model line, how does it relate to price? The way in which it actually relates to the specific price level is that the composite model line is rooted to price at the beginning of the analysis, which in this particular case, and we'll zoom all the way out in a moment and take a look, but in this particular case, it was a long time ago. I think it was it 12 years ago or something like that. So that's where the composite model line is rooted to price. When you zoom in to take a look at a particular period of data, the composite model line is adjusted up or down to fit the currently visible price. Okay, so the first really important point about the composite model line is it doesn't represent a specific price level. So a really important point. What it shows you is using the amplitude as measured and the wavelength as measured of these cycles, then this is the way in which price was expected to move. So we can see here, let me quickly turn this pen off. You can see here, I'm not showing all cycles. I can add the shorter cycles, and I can get detail, but I find looking at the shorter cycles is not really very instructive. So the shortest cycle that I'm looking at here is the 20-day cycle. And so if we take a look at what this composite line was telling us, it was telling us that during this time period here, the model Sentient Trader has indicated the price should have been rising. Then it should have corrected a little bit downwards, and then it should have risen again to this sort of period over here. And if you take a look at that webinar on the 14th of September, when I first spoke about the composite line, you'll see the composite line was indicating that the price was due to turn down. Of course, price did turn down and move down like that. And that's the cycle information that Sentient Trader has for this period of time, was that the cycles should have been influencing price to move down. Okay, of course, price did move down, at which point price was expected to move up again, according to the cycle model. So really important to bear in mind when looking at this line, it doesn't indicate a forecast. That's a really important point, and I cannot stress it enough. You know, when we were sitting over here at this date, the composite model line might not have looked exactly like this, because the composite model line is taking the cycle information that it has, that Sentient Trader has, and it is generating a forecast as a result of that. So let's just, I'm going to get a question that I see there in a moment. Let's sort of finish this train of thought. I started off by asking how much is price going to move down into this 80-day trough that we are expecting over here, that nest of lows. You can see that using the cycle information that this has at the moment, the price is expected to move down a little bit into this little 20-day nest of lows. Then it's actually going to come up and form another later higher peak before it moves down, and actually doesn't move down very much at all. Okay, so that is what the composite model line is telling us, and it's not magic. It's important to realize it's not just pulling this out of thin air. It's using the cycle model that it has. Now, why does Sentient Trader think that price is going to drop down strongly into the 80-day nest of lows over here? The reason, because of the analysis and because of the model that it has, in particular, the fact that this is a 40-week cycle trough, and because of the 40-week cycle trough, we are expecting the 40-week cycle to pick up some upwards impetus. Okay, so that's why it is saying that. So the important thing to bear in mind here, the takeaway point from this particular analysis, is that we are expecting an 80-day cycle trough to form in November, and yes, price will move down into that trough. However, according to this analysis, it might not be a very impressive move, and so our next trade will be a long trade as price breaks out of that 80-day cycle trough and moves upwards. Okay, but before you rush off and set your stop entry orders, let's just answer some of these questions. And let me just zoom out here. I see, here we go. Paul asking, how did the composite model look back in July, August? Okay, so that brings me to, let's zoom out a little bit on this composite model and speak about what's happening here. Let's speak about what's happening here. All right, what I want to do is I want to show the peak analysis. Now, this is another new feature of Sentient Trader. Sentient Trader performs a dual analysis. It analyzes troughs and also peaks. I won't spend too much time speaking about it. It's a big subject all on its own. But you can see that according to this analysis, Sentient Trader has phased or marked the trough, the high price that we saw in May, as the 54-month cycle peak. That's a really, really important point. That price, according to this analysis, is the 54-month cycle peak. Okay, very, very important. So what did Sentient Trader expect to happen? Well, I shouldn't say what did Sentient Trader expect. Let's be careful of the choice of words here. According to this cycle model, price should have, of course, fallen from the 54-month cycle peak over here. And this run here that we see up here is the move up to the 40-week cycle peak. I'm sure you can all see that. Okay. Now, I've mentioned that you mustn't take too seriously the exact price levels, because the composite model line has to do with relative movements in price because of the amplitude of the cycles. So you can't take the exact price level. We're not necessarily going to get a projection all the way up to 2240 or whatever that projection is. But one way of looking at it is just we zoom in a little bit, and we can speak about relative levels. So what the composite model line tells us is that according to this analysis, we would expect this peak here, which is likely to happen early next year, and it will be a 40-week cycle peak, to occur at roughly the same level as the high price that we saw in May, perhaps slightly higher. Okay, so that is according to this. And as you can see, here we go. We're in this kind of move over here. Now, as a matter of interest, that little sort of thing that I drew there, let me just draw it again. This line here, small trough, not very bullish, followed by a bigger bullish move, is something that you often see. And when we get to the euro to US dollar, I'm going to show you how a very similar thing happened in the euro to US dollar. We're following the fairly big magnitude trough. You get a very small, insignificant sort of a cycle playing out, and then the big bullish move takes off. So this analysis is fairly bullish. But before you breathe a sigh of relief and say, great, the markets are going up, it's very important that we question the analysis and we consider what other analyses might actually be playing out here. So this analysis is the default analysis, as I've mentioned, and in particular, it positions the 40-week cycle trough in August. Let's play around a bit, and I'm not going to waste your time. I've already done this, and it's quite easy to, let me just zoom out on the chart, I think, and show you the difference here. It's quite easy to explore different analysis options. What you will often find when working with Sentient Trader or with Hurst cycles is that different analyses give you the same trading results. It's a really important thing, and it's something you should be doing for yourself. Explore different analyses and then ask yourselves how your trading decisions differ. So let's take a look. I see a question from Nathan there. I'll get to that in a moment. Let's just finish this train of thought. Here's the alternate analysis. The alternate analysis differs in only one way, and that is that this trough in October of 2014 might have been only 40-week magnitude, which means that the trough that we saw recently in August, at the end of August, was a trough of 18-month magnitude. So there's a difference of 1 degree of magnitude, and that's something that you're often going to find, is you can look at an analysis and say, well, that trough in August was definitely a trough of either 40-week or 18, and if you find that disconcerting, it really shouldn't, because if you're only 1 degree of magnitude out, you can nevertheless make some very good, very sensible, correct trading decisions. So what's the big difference with this analysis? Well, I'm not going to dwell on it, but let's just put this composite line and see what this composite line is telling us. Let me see if I've got all the cycles included there. There we go. Okay, so this is what this composite line is telling us. Let me quickly show you my peak analysis. Okay, and let's just focus on this period over here. Now, this analysis is painting a slightly different picture because of the differences in the analysis. Again, we have a 54-month cycle peak in May. Price is bouncing up now to find the 20-week cycle peak. That's this move over here. And we're expecting that peak fairly soon. Then what's going to happen is we're going to have a move down into the 80-day cycle trough. Okay, and then the market's going to struggle and it's going to reach the 40-week cycle peak over here. So not very much higher. What's the big difference with this analysis? The big difference is that this 20-week cycle peak is likely to be the important peak rather than the 40-week cycle peak. Now, in our other analysis, the 40-week cycle was a really important one. Paul Smeedinghoff says, is the composite line the same for peak or trough analysis? Yes, it is. What happens is that it is a combination of the peak and trough analysis, Paul. So Sentient Trader takes all the information for the trough analysis, and if there is a peak analysis, it takes all the information for that, and it combines them, puts them together, and you come up with one line that tells you all of the cycle information that Sentient Trader has available to it. Okay, so we've looked at two possible alternates. What's the big difference here? Well, the big difference here in terms of us making our trading decisions is this. First of all, something that is quite worthwhile pointing out. And let me just see if have I got. Yes, I've got the 20-day included there. Okay, something that's really worth pointing out is that this big move here stopped matching our price activity. Can you see that? There was a move down followed by a move up, yes, but the composite model line is not matching very closely the price action line. Does that mean something's gone horribly wrong? No, it means, and it's important that you understand exactly what it means. What it means is that the cycle model that Sentient Trader has as a result of this analysis has not matched price action very closely recently. And that's an important point, because if your composite model, your cycle model that Sentient Trader has as a result of the analysis doesn't match the price action, then it means that perhaps the cycle model is not as good as it would be, particularly recently. And why is this? Well, because Sentient Trader, using the cycle model that it has an 18-month cycle trough over here at the end of August, and it expected clearly a much bigger move coming out of that cycle trough. So the move has been a little bit disappointing, and we had a bit of a wobble over there. But it's an important thing to bear in mind. And when I'm looking at this analysis, I'm less inclined to really trust or believe in this analysis. The other analysis looks a little bit better to me, with the 40-week cycle trough at the end of August. What is the big difference here? Well, in terms of making trading decisions, the big difference is this, that the next tradable move is going to be the move down from the peak, which is going to form soon. This 20-week cycle peak is going to form soon. It might be forming as we speak, and then the move down into the 80-day cycle trough is going to be worth trading. Very important. So our next trading decision is that we go short for the move down in cycle trough. And at the end of the analysis of financial markets, you make a sensible trading decision. So now we have two analyses. The one says that the move down into the 80-day cycle trough is not going to be worth trading. This one says that it is. So which one do we do? Well, before we make a final decision, let me show you a third analysis. And here we go. This analysis is something that I presented a month ago, 14th of September. And this was at the time my preferred analysis. I still think it's a very interesting and quite an important analysis, because the implications of this analysis are really fairly bearish in the long term. The big difference with this analysis is fairly simple. Let me turn this pen on again. The big difference with this analysis is that the 40-week cycle trough is not phased in August, but is in fact phased over here in July. Do you remember at the beginning of the webinar, I pointed out that this particular trough in July had been phased as only a 20-day cycle trough, and that didn't really seem to make sense. In this analysis, I've resolved that by pinning that trough there. I've positioned it there, and you can see that 40-week cycle trough occurs 264 days after the trough in October of 2014. The average length of a 40-week cycle, you should know, is 274 days, is it? Or 272? I don't even know. 274 days is the average length of a 40-week cycle. And so that was a 40-week cycle that potentially occurred 10 days early. Now, this analysis is very possible. I'm going to say likely, but it's certainly very possible. And let me show you why it is bearish. Here we had the 40-week cycle, and then the next 40-week cycle is expected to be roughly symmetrical into this 18-month cycle trough that is expected towards the middle of next year. Okay, so this is a fairly bearish analysis. In terms of an update to this analysis, you can see that this big trough in August of this year was the 80-day cycle trough, and then we had a 40-day cycle trough forming in October. And so what are we expecting with this analysis? With this particular analysis, we are expecting, let's zoom into this area here, we're expecting a move down into the 20-week cycle trough, which is occurring over there. So we're expecting a move down into the 20-week cycle trough. How much of a move down? Well, we can turn again to the composite model line, and we can, let's see, we can display that composite model line. There we go. There. Now, there's several things to notice about the composite model line. First of all, the very strong move down in August is not accounted for by this composite model line. I'm sure you can see that. The composite model line is, of course, moving from this trough here, moving sort of generally upwards to this peak over here. So that's not accounted for in this composite model line. That's not an error. It means the cycle model that Sentient Trader has as a result of the analysis does not fully explain that strong move down. So it is a point of some concern. But as you can see, if this analysis turns out to be true, then the next move that we're going to enjoy in the markets is a very strong move down. At the end of the day, I presented three analyses. We have two possibilities. We have two analyses that show that we will benefit from a strong move down coming soon and starting very soon. The first analysis that I showed you indicates, however, we should not enter into that that move down, but we should rather wait for the bounce up. So how do we resolve that? Let me quickly resolve this question before I get to answer some of the questions that I see in the chat window. Let's turn off this composite model line so that we're not distracted by it, and let's just zoom in on this particular analysis. Let's make a trading decision. According to this analysis, of course, we are expecting a fairly strong and impressive move down from a peak. Let me just turn on the peak phasing here so you can see that peak phasing. There we go. There's the 20-week cycle peak nest of highs. Okay, there's the nest of highs. So we're expecting a 20-week cycle peak to occur soon. So the 20-week cycle peak should occur soon, and we're expecting a good strong move down into the 20-week cycle trough. And what would be a good entry level? I use the FLD. You know that I enjoy trading interaction between price and the FLD. That would be, of course, an F category short trade for the move down into that trough. According to this analysis, that would be a very useful trade to enter, a very trade. And the same thing would be true for the second analysis I showed you. Let me quickly show you the first analysis. This is the one that indicates a very different picture. And let's focus on this over here. There is our FLD. And you can see that according to this analysis, a 20 cycle peak actually occurred over here. And so what price is now doing is it's rising to a 20-day cycle peak, and then it's going to reach a 40-day cycle peak. And the move down into the 80-day cycle trough would not be worth trading. So you need to choose one of your analyses, decide which analysis you believe works best for you. I believe the other analyses work best, and I would be interested in trading the interaction between price and the FLD. However, I need to bear in mind that it is possible that the move down to the 80-day cycle trough will not be very impressive, and then we need to have a bounce up. How do I incorporate that into my trading decision? Very simple. If you believe that this is a likely scenario, what I would do is reduce my position size. I still enter into the trade coming down into the 80-day cycle trough, because even according to this analysis, we do expect to move down into the 80-day cycle trough. There will be a move down, but I will enter a smaller position size, a smaller sized trade, and I'll set much tighter stops standing by to make sure that I enter to the long trade for the bounce out of the 80-day cycle trough. Let me get to answering some questions, and then we must take a look at the euro to US dollar. Let me see, I've missed several questions. I'm just going to go back into okay, Paul asked, what did the composite model look like back in July, August? I spoke about that. Nathan, how about the next 54-month cycle trough? Okay, let's take a look at the next 54-month cycle trough. And let's see, let's just zoom all the way out on this chart. And let's show some semicircles. There we go. So the next 54-month cycle trough, according to this analysis, Nathan, is sometime in 2017, probably towards the middle of 2017. I hope that's what you're asking. And according to this analysis, just a different one. Where's our next 54-month cycle trough here? This analysis doesn't include 54-month cycles, but it would be 1, 2, 3. It would again be about the middle of 2017. Okay. Paul asked, is the composite line the same for peak and trough analysis? Yes, as I mentioned, I think I've answered that. Connie, can you look at composite line in gold in the longer term? Yes, Connie, we can do. I'm not sure that I'm going to be, in fact, let me see, I do have a workspace for gold. Didn't think we'd have much time to really speak about gold, but let's just see if I've got a composite model line here. There we go, Connie. That's the quick answer to that question. I should really spend a little more time explaining it, but that is the composite model line. In last week's webinar, John was speaking about the fact that we're expecting a really important, prominent trough around about now, might have just occurred. And you can see this particular analysis I have that the trough has been positioned, which is questionable, and we can debate it, but you can see the result of that trough is a very strong move upwards to new highs in gold. Okay, I hope that answers that question. I should spend quite a long time explaining it and doing that, but there's a quick answer to that. Paul Leopold, how do you search for the cycle length to use in each period you're analyzing? Okay, that's a really interesting question. And I see you have some other questions here. Let me just see if they're connected. Each diamond and circle at the bottom represent each cycle bottoming. At that point, are the same cycles used each time? The composite algo changes, the composite algo constant, and the cycle selection changes. Right, okay. And so I think that's a quick sort of summary of those questions. Okay. All right, so let's speak about how do you search for the cycle lengths for use in each time period. That gets to the heart of performing a Hurst cycles analysis, and it also answers. I will also be able to answer another question that we have had, which has to do with using the initial cyclic model as opposed to the nominal model. Let me just speak a little bit about all of this and show you. Okay, so here's how you perform an analysis. Let me choose let me choose the default analysis. Here is how you perform an analysis using Hurst's cyclic principle. What you do is you start with a list of cycles, what we call our nominal model, and it is really just a list of cycles. And I can show you in Sentient Trader the nominal model for this particular chart, which is the default nominal model. Here you can see details for this particular nominal model, and it's really a list of cycles, and each cycle has a name. It's called a descriptor. I don't know why it's called a descriptor, but it's the name for the cycle. So the longest cycle in our model is the 18-year cycle, then the 9-year cycle, then the 54-month cycle, all the way down to the 5-day cycle. There are 11 cycles in your standard nominal model, and each one of those cycles has an average wavelength. Now, the average wavelength that we use for these cycles is the average wavelength, interestingly, that Hurst found for each one of these cycles 40 years ago. And when I started developing Sentient Trader, the first thing I said to myself I needed to do was to run new analysis on stocks and work out whether those cycle wavelengths were still accurate. And I performed a lot of what's called spectral analysis, which is identifying the wavelengths that are active in a price movement. And I used American stocks and stock indices in particular. I used data on the Dow going back to 1898. Somebody kindly provided me with fantastic, very long-term data. Did a lot of analysis on it, and the results I came up with were not identical, but they were very close. And in fact, they were so close that eventually, after doing several months of these tests, I realized that I was effectively wasting my time, because the cycle wavelengths that I was finding in the data were the same cycle wavelengths that Hurst had found 40 years ago. Even when I performed an out of what's called, when I used data after the 1970s, which a good deal of my data was, I found the same average cycle wavelengths. So that is the average wavelength of a cycle. And in your nominal model, then, you have a list of cycles with their average wavelengths. They have a particular harmonic ratio to each other, as you can see. Normally, one of our cycles has a 3-to-1 harmonic ratio from 18-month to 54-month. It's a 3-to-1 harmonic ratio. And so that's your list of cycles. Then what you do when you perform an analysis is you identify really important troughs, such as this one here, and you start with the longest cycle that you could do, which in this particular case, according to the amount of data that you have, which in this particular case is the 54-month, take a piece of paper or you measure the distance. So you're saying, I'm expecting a 54-month cycle to occur, and let me see if I can turn my pen on with that. It's still there. Yes, I can. So there is 54 months. That means that I'm expecting a 54-month cycle to occur over here. So it could be that trough, or it could be that trough, or that trough, or that trough, or that trough. Okay, so within a sort of a range side of that cycle, you expect that particular cycle trough to occur. Right, then what you do is you step down one cycle and you start looking at your 18-month cycles. And again, from your very prominent trough on the left there, you measure 18 months. And so where's 18 months? There it is. Can you see a big trough near to that 18 months? Yes, you can. So there's the 18-month cycle. So then what you do is you measure 18 months from there and turn the measuring tool off. 18 months. So you measure 18 months. Can you find a big trough close to that 18 months over there? Yes, you can. And again, try and turn this pen on over here. So there is that 18-month cycle drop over there, and you continue doing that, and you 18 months from there, and you come up with something over there. All right, and then you ask yourself, where is the nearest trough to that 18 month? I've just moved it anyway. That was somewhere over here. And so then what you say is that 18-month cycle must, of course, be synchronous with the 54-month cycle, and therefore it could be this trough, perhaps it could be this trough, or it could even be this trough. You put question marks under those. Those are meant to be question marks. They didn't turn out very well. But you put question marks under those potential troughs, and you continue doing that, working down cycle by cycle. You go down to the 40-week cycle, the 20-week cycle, and so on, all the way down to the 5-day cycle. And at the end of the day, you are able, therefore, to resolve the positions of the troughs of those cycles. And so therefore, by positioning the troughs of those cycles, you're able to measure their wavelengths. I hope that explains how do you search for the cycle wavelengths to use in each time period. So now let's answer the second part of your question there. Are the same cycles used each time the composite algo changes? Okay, the composite algorithm doesn't change. The composite algorithm is very simple. What Sentient, well, I say simple, it was pretty complicated to do, but what Sentient Trader does is it takes all of the information that it has as a result of this analysis, and it puts it together. So let me turn on the composite line for this particular instance, and let me include that 54 months. So it puts together all of the cycle information that it has. All right, and it plots this line. So this orange dashed line is rooted, as I mentioned, at the beginning of the analysis. You can see it's rooted there at price. It literally, I tell it, start at this level. I don't tell it, the software tells it. Start at this level, which is 15 something or other, and then using only the cycle model that you have, which is the wavelength of each cycle and the amplitude of each cycle, build me the composite, or show me what price should have been doing. And that orange line is the result. And so if you were a computer and I handed you the cyclic model that is the result of this analysis, then you would understand that that is what price was doing. Of course, price doesn't do exactly what the composite model does, because there are times where price deviates from the cyclic model. There are times when price behaved in an unexpected manner, such as you can see a clear deviation. And over here, there's another clear deviation. Those deviations are also important. I'm severely running out of time, so I think we're not going to get to the euro US dollar this week, but let me just quickly say something about those deviations. Those deviations between the composite model line and the actual price action are very important, because it means that that the price didn't follow the cycle path to perfection. If I clear this and if I clear this, you can see that orange dotted line, and perhaps I should change this to a weekly chart because it would be just a little easier to see, or even a monthly chart. Let's see what that looks like. Yeah, there we go. You can see that composite model line, let me turn off the semicircles, just confusing everything. That composite model line describes fairly accurately that price action most of the time. But there are periods of time where it doesn't. In particular, this peak over here and this little period of time over here. Times where price action isn't perfectly modeled by our composite model are very important, because it means that our cyclic model is breaking down in some way. Price is behaving in a way that wasn't expected because of the composite model. And let me just cut straight to the point. It's very important recently that this peak in May which should have formed much higher, didn't form very high, and didn't form as high as it should have, and so the cycles turned bearish a little sooner than would have been expected, which is why I am particularly bearish in stock markets around the world. And I see, Bob, can I show the Euro composite line? Let me quickly do that, because the Euro composite line, I did say I would speak about the Euro US dollar today. I didn't really get there. I'm going to come back to that as well quickly. That'll be our last topic for today, I think. Okay, composite line for the Euro to US dollar. This is the Euro to US dollar, and I did really want to speak about it. I will have to push this onto next week. Perhaps we'll take another look at the Euro US dollar. Here's the composite model line for the Euro to US dollar, and you can see, in simple terms, the 4-week cycle trough is what's expected to form over here. The composite model line is telling us that we're currently in this little move up here. Then we're going to get, a sort of a gradually descending, bearish shaped 80-day cycle, which is going to have its end towards December. Glance. I wish I had time to explain that. There's a lot more to say about the euro, but we're running into an hour already, and I did promise that I would speak about choosing your analysis start period, so I really must quickly get to that. Let me see if there are any other questions I can answer quickly before I get to speaking about the analysis start period. And I see Sergio, if I create a custom nominal model for an index, ES DAX, can I use it for another index? I have to create a new one. No, absolutely. If you create a custom nominal model, you can use it. Anybody can use it. In fact, if you share your spaces, which we strongly encourage you to, then the workspace file includes the nominal model. So I'll show you. This is my analysis of gold, and after last week's webinar with John, I was able to load his nominal model. There it is. Okay, so all you do, Sergio, is you go to analysis, nominal model, assign to chart. Okay, it gives you all kinds of threatening messages, and then you choose your nominal model. And if you've created a nominal model, you'll find it there. There's John's gold model. I called it a silver model, but it's the same thing. And so now I've sent that chart off to do a fresh analysis. So I hope that answers that. Euro US dollar analysis is very important. Okay, well, I did say we would look at the Euro US dollar. So let's quickly spend just a few minutes going through the basics of Euro to US. I spoke 3 weeks ago about the Euro to US dollar, and as you know, I had two fundamental analysis options. This is one of them. So let's just quickly zoom out, and I'll show you the. Let's turn off that composite model line. Show you the bigger picture. The bigger picture is that the 54-month cycle trough formed earlier this year in March 2015. There's the orange semicircle, and so we are seeing the euro US dollar bouncing out of that 54-month cycle trough. That's the bigger picture, and let's zoom in again and take a look at what's happened since then, and have a look at what we're expecting. Let's turn off the semicircles. Okay, so here is what has happened since then, and let me just, there we go. So here's the 54-month cycle trough, and we've been seeing very nice clear cycles in the euro US dollar, very nice clear M shapes. Here's the M shape for the 20-week cycle. 20-week cycle trough formed in the middle of July. Since then, we have seen an 80-day cycle, and according to this analysis, this is the M shape for the 80-day cycle. There's the 80-day cycle trough, which formed, in my opinion, and according to this analysis, in the 3rd week of September. And so price has been 80-day cycle. What to look for in the near future? We've got a 40-day cycle trough coming up, probably sometime next week, and then of course a 40-week cycle trough. And let's just quickly turn on peak phasing, because we can do that. And you can see the peak phasing, according to this analysis, has an 18-month cycle peak, which occurred in August. So in other words, temporarily, not temporarily, but for a little bit of time, we have seen the peak in the euro to US dollar. So don't expect it to keep moving up forever. Remember, cycles keep moving up and down, okay? So the fact that it bounced out of a 54-month cycle trough 6 months ago, or 7, doesn't mean it's going to keep moving up for another 20 months. The shorter cycles keep going. It makes for a fascinating, constant puzzle. And let me show you then the composite model line. Here's the composite model line for the euro to US dollar. And in the near future, you can see it looks as if though it's forming a peak over here, which is this 40-day cycle peak. Then it's going to come down to the 40-day cycle trough over here, bounce up to the 80-day cycle peak over there, and then come down to the 40-week cycle trough over here. So what I would do trading the euro US dollar is I'd be looking for an opportunity to go short in the day cycle trough, which is expected in about a week, 2 weeks. I probably wouldn't take this long trade here. It depends on your trading time frame, and then I would definitely be looking at getting into this short trade for the move down into the 40-week cycle trough sometime in December. Okay, I hope that shows you what is happening in the euro to US dollar. I would love to quickly spend a moment. I see a quick question from Jeff. Did you need to pin those troughs a while ago? I have the same analysis, but did not need to pin those any of those troughs. Yes, Jeff. In fact, these troughs, if you're speaking about the euro to US dollar, I pinned these troughs when I was fiddling around with the analysis, and they were very recent, and so I pinned them to position them there. One of the reasons that Sentient Trader keeps on showing the pinned troughs to you is that you should every now and then clean up your workspace and remove them, because as you say, eventually your default analysis just puts those troughs there anyway. So I tend to do that. I tend to do it only once a month. I should probably do it more often, but once a month I sort of go through and clean up my pins, and I remove any old ones. Okay. Viganta says euro short from now or next week. Okay, so Vigantas, the important thing is what Hurst cycles do is they tell you what move to expect. Okay, so we are expecting a move down from the 40-day cycle peak. Now the 40-day cycle peak, you can see from this composite line, is due roundabout now, but there are many different ways of trading it. Some people go short when they're expecting a peak. Okay, so you're expecting a peak, so you go short. That's not my personal style of trading. I do know traders who do it. It's a dangerous way of trading because cycles suffer constant variation. And it could be that this cycle peak comes later than we're expecting. And a 40-day cycle peak could come a week or 10 days later. You don't want to be in a losing trade for 10 days. So what most cycle traders do is they wait for evidence that the turn that they're expecting has happened. And as you probably know, I use the 20-day FLD for that evidence. So if we zoom in here, you can see here the software is saying the peak should be happening around about now, and it's going to move down into the 40-day cycle trough over here. I would use as evidence that the turn has happened the 20-day FLD. So I would enter my trade at the level of the 20-day FLD. So price could go up for several days, then turn down. When it crosses below 20-day FLD, I get into my short trade. Now, depending on whether you're an optimist or a pessimist, you might tell me, if you're a pessimist, you might say, oh, but you've missed half the move. Yes, you have. You've missed half the move. But I'm an optimist, and I say, well, I've still got half the move left. Okay, so it really depends on your trading style. That's a really big conversation. It depends on your trading style. What I do is I wait for price to cross that 20-day FLD. At the level of the 20-day FLD, I get in, and I get in for the second half of the move. So yes, I've missed half the move, but I don't worry about moves that I've missed. I worry about moves. I hope that makes sense. And right, Dave, that answers the question. Do all users get the upgrade? Yes. Okay. I see Sam's analyzing that. Fantastic. And Bob says, is there an alternate Euro US dollar analysis? Yes, there is. And this is my alternate analysis. If is only very slight. It uses a different model. And if you haven't seen the web from 3 weeks ago, please go and take a look. They're all uploaded to YouTube. You can have a look at them. And so the webinar 3 weeks ago, I spoke about the euro to US dollar. And this analysis applies a different nominal model. So it is a different analysis. And here is the result of the composite model line according to that analysis. And the important thing here is that we do still have a short trade happening now. All right, but then the bounce out of that is going to be longer and more impressive, and then the move down into the 40-week cycle trough, which is this one here, different nominal model, so it's a different magnitude, is going to be a less impressive move, and then of course we're going to get the bounce out of that. So the important thing about the euro to US dollar, let me just make this point because it's something that many people struggle with. Here is the alternate analysis. What are the moves that we are looking at? And the composite model line shows us those moves. It shows us a move down, okay, which is a move that we can definitely profit from. So we're looking at a short trade entering round about now or fairly soon, sometime this week, and getting out in about the 25th of October, roughly. Then we're looking at a move up, which will also be a profitable move that will be worth trading. Then we're looking at a move down that might or might not be profitable to your time frame, into the trough here right at the end of November, perhaps early December, and then a big move up. So we've got 1, 2, 3, 4 moves there that are worth trading. Now let's look at the alternate analysis, and here we go. And let me just zoom out a little bit, clean this chart up, and get roughly the same sort of time frame there. Here are the same or moves. Short move, okay, then a long move, not as profitable as the other analysis, but nevertheless a long move. Then a big profitable short move, move 3, and then a profitable long move. The important thing is that in both the analyses we get the same moves that are indicated. The difference is really in terms of the extent of each one of those moves. Now both of them indicate short move is going to happen fairly soon and is going to be worth trading. So I would definitely trade that move. Both of the analyses had a bit of a bounce up. This one doesn't look very impressive, so it might not be a move worth trading. Depending on your time frame, might make it. Both of them then have a move down into the end of November. Depending on your time frame, again, you need to decide whether that's going to be worth it. According to this analysis, it will definitely be a trade worth making. According to the other analysis, it might not have been. So that is the big difference. Finally, both of them had this nice profitable trade over here. So one way of working with Hurst cycles is when you have two different analyses, you look at the moves that are in common between them and you trade those moves. In this particular case, it would be a short trade now, and from the beginning of December, this very nice long profitable move over here, which is common to both of those analyses. Okay. I would like to see some more questions, but I did promise that I would speak a little bit about choosing your analysis period in this webinar. So let me quickly speak about choosing your analysis period. I don't need very long, I hope, to speak about choosing your analysis period, because let me just do it here. Is this the euro to US dollar? Yes. Let's see. I've got one of these charts all prepared. Here we go. Okay, this particular chart. Now, what I've done with this chart, I hope you can see, is I've loaded all the data. Here is the euro US dollar data. I've loaded it and I haven't set an analysis period. Just to be clear, one of the things you have to do when you start working with Sentient Trader is you have to tell Sentient Trader what part of it must look at. What piece of the data must it analyze? In particular, where should it start its analysis? It's called choosing your analysis period. Now here you can see full colored bars throughout sequence, and that indicates that Sentient Trader is analyzing all of the data. Okay, I haven't specified analysis period. Now some people get a little bit worked up about choosing their analysis period, and they get a bit confused about it. How should I do it? It's not really that complicated. What I usually do is I load the data and I hit the big green button, which you can't see, it's off the top of the screen. I hit the big green button, I tell Sentient Trader to perform an analysis. Sentient Trader will analyze all of the data. Then I look at it and I say, do I have a problem here because of the analysis period? And in this particular chart, I do. And let me explain to you what that problem is. Perhaps some of you can get it. It's not really very hard to spot. And here it is. I'm not going to wait for an answer because we're running a little late. Look at this 54-month cycle, the long cycle. Here is the trough of the 54-month cycle, and it's connected to this trough in price. Okay. Here is a 54-month cycle, and it's connected to, wow, this trough in price. Okay. And here's a 54-month cycle right at the left-hand edge of the chart, and is connected to that trough, which looks quite impressive. So there are some problems here. Can you see them? This first cycle, 54-month cycle, did this. And you know, it had this really big trough over here, which isn't a trough of the 54-month cycle. The next 54 months had this big trough here and this big trough here, both of which were lower than both the starting and the ending troughs of that cycle. Can you see that? It's very simple. Let me just show it to you again in case you're not clear about it. Here is the starting trough, and here is the ending trough of that cycle. And if we draw a line between them, there are two troughs in between, which are deeper. They are, there are more impressive troughs, and yet according to the analysis, they are less important troughs. That's a sign that there's something wrong. That's the first sign. So if you see something wrong in your analysis, the first thing you should do is question your analysis start period. Let me show you how we can do that. Let's zoom in here to the left-hand edge of this chart, and I'll show you what is going wrong with this analysis. There's the data daily. Okay, so our 54-month cycle trough has been placed over here, right at the left-hand edge of the chart. Okay, what you can see there is the left edge of the chart. So it has placed a 54-month cycle trough at the left-hand edge of the chart. That's what I call the 54-month cycle, the left-hand edge problem. So I've been speaking too long, I'm losing track. That's what I call the left-hand edge problem. And what is the problem? Well, Sentient Trader cannot see anything to the left, of course, of that chart. Okay, it can't see any further left. So when it looks at this trough, and let me just sort of move it around a bit, when it looks at that trough, it says that is a really important trough because look, price hasn't dropped below it. Price hasn't dropped below it ever since. It must be a really important trough. But as humans, we can use our imagination and we can say, well, yes, but, and let me just move the Trader over to the right. We can say yes, but What happened before that? Okay, let me change the color so you can see it. How do I know that price didn't immediately drop to a lower trough and then bounce up again? That's the left-hand edge problem. Sentient Trader lacks imagination. It's pretty powerful software, but it doesn't have imagination, and it can't ask itself what happened before the start of the data that it can see. And when I was developing Sentient Trader, I did a lot of tests with getting Sentient Trader to ignore troughs at the left-hand edge of the chart. But the problem with that is that Sentient Trader started ignoring data that you really wanted to include in your analysis. So there are two problems here. And the two problems, as I've pointed out, are that you have a left-hand edge problem. Sentient Trader has positioned a very, very important right at the left-hand edge of your chart. And the other problem is that the longer cycles aren't matching up with good trough positions. When you see that problem occurring, that is because you haven't chosen your analysis start period properly. Okay, so what you need to do is you need to choose your analysis start period. Now, the way in which you do that is you solve the riddle of where is the first and trough in this price data, and it's really not complicated to do. Let me show you what you do. You start at the left-hand edge of the chart, and you look at each trough, and you say, can I say that is probably a trough of a really long cycle? So this first trough, which we can't even see at the left-hand edge, clearly not. Price could have been much lower just a few weeks before. So that's not a good analysis start period. This trough over here, which looks like is at about August or September of 2004, I think. Could you say that's a really prominent trough? No, because price was below it just a few months before. Okay, the left-hand edge. And in fact, let me zoom in because this is getting really quite difficult to see. Let me zoom in on this data. And so we definitely can't say this trough here because it's too close to the edge. This trough here cannot be a really important trough because it's still much too close to the left edge, and there was a lower price just over here just 6 months before. So that must be a maximum of a 40-week cycle trough. What about this trough over here? Could that have been a really long cycle trough? Well, no, because again, only in this case about 6 months before, price dropped lower than that. So let's forward. What about this trough over here? Now we're talking, because there is a good sort of 18 months. Okay, so this trough here is likely to be a very trough. So I want Sentient Trader to find this trough here in November of 2005 as my first important trough in the analysis. How do I do that? Well, what we used to do is we used to turn my pen off. We used to look at the move down from there to the trough, move forward about a third, and just arbitrarily choose that point. As a matter of interest, it's quite useful now to use a slightly different approach, because you probably want to include this peak in your peak analysis if you're going to be doing a peak analysis. So in fact, I now choose a point just before that peak. So let me turn that off, and I simply hold my mouse down there. I can see that is bar 639. I go to analysis period, click the start there. What did I say? 639. That's 2004, and say OK. You can see Sentient Trader has grayed out all of those bars before this point. Those bars are all gray, and all the bars after that point are in full color, which means that Sentient Trader is only analyzing data after that particular point. And if I zoom all the way up again, as soon as Sentient Trader has finished its analysis, it will show it to us. And there we go. There are the results of applying the correct analysis period. And do you see how the first trough that Sentient Trader has found is the one that we identified, the one that we thought looked really good in 2005. The next 54-month cycle trough over here is indeed a very low point in price, so it's very appropriate. The next 54-month cycle trough, which occurred earlier this year, is again very appropriate because there's a very low price, a very low point in price. Okay, so I hope that explains how to determine your analysis start period. It really isn't complicated, and you mustn't overstress it or over worry it. The important point is simply look at the analysis that Sentient Trader has performed. If the leftmost trough that Sentient Trader has positioned doesn't seem appropriate or seems too close to the edge of the chart, and using your advanced human ability to imagine that price moved before the left-hand edge of your chart, if you could say, I cannot justify the position of that particular trough, that cycle trough, then you probably need to adjust your analysis start period. The analysis start period is a really simple thing to do. It's the one thing that you should do to influence analysis the Sentient Trader performs. Okay, I hope that answers the questions. We get many questions about the analysis period. Robin, are you concerned with the inverted 40-week cycle in 2012? Let's look at 2012. Yes, I am concerned with. If you take a look at, I don't know if you were in the webinar where I discussed the analysis. Let me just show everybody what is meant by an inverted cycle. So here is, I think this is the one you're speaking about. Here is the 18-month cycle. Here is the M shape, and that's the M shape for this 18-month cycle from early 2012 until July in 2013. And it's what I call an inverted cycle shape because the middle part of the M drops below both the beginning and the end. That's what I call an inverted cycle shape, and it is often an indication, not always, but often an indication of a weakness in your analysis, and it causes problems with your commonality model, your composite model line. I don't have a composite model line in this chart, but let me show you. We have the same thing over here. Where are we? 2012, and it is often the cause of big deviations between your composite model line and your price action, as can be seen here. Here is that same period. Notice how the composite line and the price action diverge fairly strongly there. That's because of the inverted cycle there. Yes, and if you take a look at the analysis I did of the euro to US dollar, and let me find it for you quickly. I have for some time worked with a different nominal model in the euro dollar, and this nominal model breaks down fairly differently. We don't have a 3-to-1 harmonic ratio between, what am I looking for, semicircles, there we go. We don't have a harmonic ratio of 3-to-1 between the 18-month and the 54-month cycles, and so the result is, I hope you can see over here, I'm trying to use the back of my pen, there we go. I hope you can see over here, this trough then becomes a trough of the shorter cycle. It's not 18 months, it's 2 years. I think it's a 2-year cycle. And let me just zoom in and show you how that resolves things with the nominal model. Here we go. Yeah, okay, so turn off the semicircles. So there we go. If I show you the composite line over that same period of time, you can see how that change changes the composite model at that point. And you can see how this analysis matches to much more closely. I hope you can see that. So that answers that question, I hope. Okay, let me see if there are any final questions. It's time for us to wrap up. Bob asked, is there an alternate euro analysis? Yes, I answered that. FLD, how many to the future? The FLD is calculated on the basis of the current wavelength of the cycle in question. So if we go all the way to the end here, and let's just turn that off. The 20-day FLD works with the current wavelength, and of course the wavelengths are constantly varying, so that's the wrong chart to use for that discussion. The wavelengths are constantly varying, and so the 20-day FLD, the 20-day cycle, as you can see, the current wavelength is presented foot of the chart over here, and the current wavelength of the 20-day cycle is 16.2 days. So the FLD is displaced by half that wavelength plus 1. So you halve 16.2, you get 8.1. You round it off to 8, you add 1, 9 days. 9 bars would be the displacing of the 20-day FLD. Bear in mind that you have to have a chart that includes weekends. You must have gaps for the weekends. So if you're using MetaTrader 4, that causes very big problems with plotting FLDs. As I know, we're developing a Hurst Cycles plugin for MetaTrader 4, and the FLDs look a little strange because, of course, they skip the weekends. Okay, please don't forget to talk about the ICM versus default nominal model. I'm afraid, Robin, I'm not going to get there today. We're half an hour long, and so regrettably that'll have to be postponed, but we will definitely include it. Bob, do you have a crude composite? Let me quickly look at our crude. Yes, I did speak about crude today because there hasn't been much of a change in the analysis, and our crude composite, there's one of them, but I think and there's another. Our composite models on our crude are all looking very, very, very bearish, which was, of course, one of the possibilities. So our composite models, I wonder if I'm including, I didn't really set this up, I didn't spend time with it. There we go. Yeah, our composite models on our crude analysis are all looking very bearish. There we go. There's a sort of look at the composite model in the crude analysis. You can see it's looking pretty bearish crude, and I know many of you are very bearish crude at the moment, so that perhaps makes sense. A watermark, which instrument is showing, Nathan? Yes, that's a very good idea, and not something we'll do today, obviously. Okay, thank you very much, everybody. We've run really very long, and it's time for me to say goodbye. We need to the markets. The US markets are opening in about a minute. We need to be there, get ready to start trading. Thank you very much for joining me in today's webinar. I do hope it has proved useful and valuable. Thank you for your interest in Hurst Cycles, and thank you for being a part of the Hurst Cycles revolution. We have a tremendous growing interest in Hurst Cycles, and it's very exciting. For all of us, thank you for being a part of it. I look forward to seeing you next week, and in the meantime, I wish you, of course, profitable trading.